Howdy, Team 42. It's your skipper here, Darius Dale, to present another episode of Pro to Pro Live. I'm joined with our friend Warren Pies, or founder of 314 Research. How you doing today, Warren?
Doing well. Nice to get a chance to talk to you.
Yeah, I think this might have been your first time on our show, so I just want to say thank you for making time for us. You're obviously a phenomenal investor, man. You do outstanding research. It's very empirical, very data driven, much like what we aim to accomplish here at 42 Macro. So I just want to tip my cap to you for that. Before we even get into it, for those of our investors amongst our client base who may not be familiar with you, can you give a little bit of background on yourself and what you guys do at 314?
Yeah, sure. If you go way back in my background, I was an attorney, and then after I kind of became disillusioned with that, I moved over to the finance world, and I started a independent institutional research shop called Ned Davis Research. Ned Davis Research, it's been around since like 1980, and they were kind of the first shop to go to take. The story is Ned, the founder, who's retired now. Went to his firm and asked to have a computer to do technical analysis, and they kind of laughed him out of the building. He started his own firm so he could kind of quantify these technical indicators that he'd been following. So that's where I started. I was there for about 10 years. I started at the bottom on the commodity team and ended up, by the time I left, I had been the head of the commodity team. My background and really what I became well known for was the oil and energy market. And that was where I kind of cut my teeth. And so we started 314, myself and my research partner, Fernando, who also used to be at 314, but has a background in data science and machine learning. He came over with me, and that was in 2020, in the middle of the pandemic, kind of a crazy thing, probably similar to your situation, and in 42 Macro. And so that's been we thought we could do it better. I respected NDR and the stuff we did there, but I mean, I definitely thought we could do it better, and that's what our goal has been, and just trying to be data driven and as cold-blooded in our analysis as possible. I think that people's emotions and political ideologies, or ideologies in general, really get in the way of their investing in this current environment. And so we try and boil it all down to data and just let the models and data speak to us.
No, I appreciate that, man. Very great background. You and I have very similar paths in terms of the pandemic being a catalyzing event in our lives to give us some clarity on what to do next. I spent obviously my former life was flying around the world meeting with institutional investors, and a lot of times in our debates, we be pushed this envelope or slide deck from you guys over at Ned Davis, man. It's like, okay, they're saying this, you guys are saying that, like what gives, So I just want to say you guys are definitely up there as well in terms of firms that I respect and that are respected across the buy side. So great pedigree, my friend.
Thank you. Yeah, that was very exactly similar thing. We used to travel every month, different places, and it was a great place. It was a great experience. I mean, you have to kind of, as you know, that once you're in that hedge fund institutional world, they don't play patty cake. You need to actually know what you're talking about and be prepared. And so it was a great 10 years. And more than anything, I learned how to code. I learned how to manipulate data, build models, and I have a curious mind. I'm just really interested in markets. So what I was able to do in that period of time was have access to a lot of data and the ability to manipulate it and just form my own opinion of things and my own philosophy. And then I've built on that at 314. It's just been just, as you know, it's like one big journey. You never stop learning.
You never stop learning. The second you think you got it figured out is the second you start losing gobs of money in financial markets. So in the spirit of not losing top gobs of money, what are your sort of big picture ideas right now? Like, just give me your kind of just general lay of the land, how you're seeing the world, how you're seeing markets, and then we can kind of drill down from there.
Yeah, we've had I feel like we've packed an entire cycle into like 2 months is what I feel. And so there's, the narrative roulette is in full effect. Our view is that we've always said that we think the economy is more resilient than most other people have believed. And, but at the same time, I would say, if we're being totally honest, we even didn't appreciate how resilient this economic backdrop is. And so going back to the beginning of the year, we were saying, soft landing is not our base case, but we see a path to it. And we think the path and probabilities are wider than the consensus expects. And we laid out our markers. We said, here are our three things that you need to see for a soft landing. You need to have a resilient economic backdrop. You need to have rapid disinflation, and you need to have a hyper-reactive Fed. And my belief has been, we're going to get two of those things. We're going to get rapid disinflation and a resilient economic backdrop. But I did not think the Fed would be reactive enough to engineer a soft landing from the way we saw it, and that has changed really. I'd say the real sea change was when Christopher Waller came out with his speech and essentially blessed the John Williams approach, which is this real policy regime. So I think we have subtly shifted from a nominal policy regime to a real policy regime. And I can explain what that means, but it basically means this whole 2% target thing that we've looked at for years and talked about is dead. That's not the number we should be looking at. And it means that the Fed is moving from tightening to accommodative, and it's happening quicker than I think the consensus for sure expected. So a lot of people are off sides. And if you don't see a recession coming, you see the Fed, doing these mid-cycle adjustment cuts. The way we've been saying it, to sum it up for our clients really simply, is that yesterday's tightening becomes tomorrow's stimulus. So that's the framework. That's the setup that we see. We think soft landing is now the base case. That's and then everyone will say, well, that's consensus. I don't see that. I don't think that's consensus yet. It's really not a very tightly formed consensus as of yet. If you look at Bloomberg survey of economists, for instance, there's a 50-50 odds of a recession in the next 12 months based on that survey, which that's down from 60% 1 year ago. So yeah, there's more economic pessimism a year ago, but shoot, that's way above the typical reading that you get on that kind of a measure. So in my view, there are still a lot of signals that are being misinterpreted by the market, the inverted yield curve and things like that. And that gives opportunity. So there are a lot of people that have to kind of get converted to this viewpoint, and the market is forcing their hand right now. So we just released our outlook yesterday, and everyone, not to bury the lead, but I think there's going to be a powerful equity rally through up to May. That's typical of a soft landing. You get your first cut in a soft landing. Stock market rallies on average 10% in the 6 months before the cut. So soft landings, the market interprets or anticipates Fed action much more than other cycles, and you have to parse your cycle analysis in a way that's unique, I think, in this situation. So I think we're in the middle of that kind of fever catch up, and the same thing happens to bonds in that environment, where bonds interpret the first cut and then yields drop into the first soft landing cut and then are basically flat. So that's the lay of the land. That's a pretty big shift on our part, because of the posture that's happened from the change in posture from the Fed in this transition from a nominal policy regime to a real policy regime. So that's where we're at right now.
Lots to unpack, my friend. That was thank you for explaining all that. Very, very helpful. I think the number one thing that sort of I latched on to is this sort of shift from the nominal to the real policy regime. Can you unpack that a little bit? And then maybe on the secondarily, if it makes sense to speak about at the same time, kind of also unpack why you think the yield curve signal may be a red herring in this particular cycle.
Yeah, you're asking the right questions and the more interesting ones. So the nominal policy regime is what we went through, where it was, hey, 2% inflation is our target, and we're going to hike or hold in restrictive territory until we hit that target, period. So we get to restrictive and that's it. And the real policy regime has been something, if you go back to an August interview with John Williams in the New York Times, he really laid it out well there. And it's been endorsed since then by Waller, and then this week also by Janet Yellen. And the real policy regime is that the spread between your Fed funds rate and your inflation rate, measured inflation, however you want to look at it, core PCE, I guess, in the Fed's case, but you can look at core CPI or CPI in general. That difference is what matters, the real rate that they're inflicting on the market. And when you go back through time, and so what they're prepping the market for through these speeches is that the real rate is probably not going to get much above 2%. So that's Fed funds rates at 5.5 right now. Let's just think of core CPI for a minute. Like core CPI is at 4, so that's a 1.5% real rate. As core CPI drops, or core PCE, which is even lower, drops, you get a wider real rate. Now we go back to the dots that just came out, because I think that's another communication tool. The dots came out and showed from September, if I recall, just off the top of my head, there was basically they had a 5.1% Fed funds rate. They marked that down by 50 basis points, and basically marked down their inflation, their core PCE, by by a hair. And the bottom line was the real rate expected for next year dropped from 2.5 to 2.2%, communicated through the dots. And this, to me, is what they're saying. They're telling you in the dots, we're not waiting for 2% to cut. We're not waiting for 2%. We're going to maintain policy at a certain number above inflation. That's a real policy regime. And they're signaling cuts. That's why the market's gone crazy right here, because it's a huge, huge shift. So that's the shift from nominal to real policy regime in my mind. As far as the yield curve goes, now you have to first define what do you think's happening when the yield curve inverts. So here's the way you get paralyzed in bearishness or pessimism, as you say.
Paralyzed and bearish.
You have to think about that, right? So the yield curve is when it inverts, let's say 210, just to make it 2-year versus 10-year, just to make it easy, because everyone talks about it. It inverts, and then you can do all these historic analysis, and 22 months later, the economy falls into a recession. Some people talk about that like it's a prediction, like the yield curve is this like mystic foreseer of economic turmoil. And so now it's like the wick has been lit, and now the bomb's going to go off in the middle of 2024 because of this historic analysis. In my view, the real work of the yield curve is to choke off credit to the economy. So when the yield curve inverts, it upends the modern banking model, business model. So borrow short, lend long doesn't work anymore with inverted yield curve. So, we spend about 20 months, 2 years in a situation where the modern banking business model is upended. Yeah, credit's going to be choked off to the economy. And sure enough, we have seen loan growth decelerate. C&I loan growth is now rolling over on a year-over-year basis. So the yield curve is doing what it's supposed to do, and the Fed is tightening policy and inflicting that on the market. But on the other hand, we're running a massive deficit, a fiscal deficit. Never entered a recession with a fiscal deficit this high. So what you see when you bake that together is there's really two broad channels of money creation. You have deficit spending, and you have bank credit creation, loans from banks. And when you add those together, I think that deficit in the background is what's really the genesis of the resiliency in this economy. So I think that the yield curve would drag us into a recession if it sat there for long enough. But let's say the average cycle is a 20-month from inversion to recession. Maybe this cycle, because of the massive fiscal stimulus and deficit spending that we have right now, maybe it would take us 40 months. I don't know. It doesn't matter, because we're not going to get there. The Fed's going to cut rates well before we get to that point. So that's how I see it.
No, it's a very interesting point. I just want to throw up a chart from our most recent macro scouting report, where we show the sort of the kind of the normalized change in the private non-financial sector credit to GDP ratio. That's the blue line in this top panel, and then we show the debt service ratio in this red line in this top panel. To your point, you rarely never hit a recession with credit growth, without some form of capital misallocation or adverse selection in the economy. And I would argue we have none of that right now, because this has been an income-driven business cycle. If you look at the 5-year Z-score of the private non-financial sector credit to GDP ratio, what economists call the credit gap, that is a minus 1.1 sigma. We've never gone into recession with a negative value in terms of credit growth. And so what this ultimately means is that the economy has been consistently growing faster than credit in the private non-financial sector credit side, which means that income is what's creating all the GDP that we're seeing in terms of productivity and whatnot. And so in my opinion, focusing on a statistic like the yield curve as, this sort of guaranteed outcome is a recession, I think is a bit rich, particularly in the context of the fact that the U.S. economy has become incredibly hyper financialized. And what I mean by that is that we no longer are a modern banking economy. To your earlier point, if you look at the share of private non-financial sector credit that's on bank balance sheet here in the U.S., it's only 33%. That's way lower than our peer economies. It's basically about half of what it is in Europe and Japan, and almost a third, just about a third of what it is in China. And so you think about, okay, well, if only a third of our credit comes from banks, the other 2/3 must come from non-banks. These are market participants, folks who are responding to things like credit spreads or, capital availability or, equity prices, volatility, the dollar, things of that nature. And as long as you're in a Goldilocks market regime, you're talking about the credit intermediation function of the economy, irrespective of what's happening in the yield curve, being actually quite positive for in terms of supporting growth.
Yeah, I think that's a great addendum to to what I'm saying. Yeah, I mean, it's the world has changed from some of the past inversions, and that's the bottom line. Is that the world, the financial markets have changed, the way credit flows through the system has changed, and clearly the amount of fiscal stimulus has been like just speaking of the income channel, the fact when one of the weird things this cycle is raising the short-term rate has increased in a very I'd say regressive ways, and increased income out to the population, through the interest income channel. So when the yield curve inverts, like I've been playing with this idea all the way back to the end of last year, is like, so you increase income, like hiking rates, and then borrowing costs come down. And, that actually stimulates this economy in a certain weird, perverse way in the short term, where the consumer can go out there because it's a securitized auto and in home loan market. They can go out there and borrow mortgages, borrow money for homes, borrow money for cars. And at the same time, the rich boomer is getting paid on their money market funds 5%. So these are weird times. We titled our outlook A Prayer for Normal. And the idea is, if you read through the consensus outlooks for next year, I got this feeling that everyone was wrong for last year. So they kind of all grouped into, what's the average year? What's the average year? And I'm saying what I think's happening is a prayer for normal. And that prayer is going to go unanswered next year. It's going to be a weird year again.
100%, man. I love you're making you're poking fun at average, because one thing I find, I mean, you and I are both skilled model builders, in financial markets and in the economy and economic data as well. We rarely spend any time at these averages, right? Like the average is this sort of bastardized number that we force into slide decks and presentations, or investors force into their trading schemes. But the reality is, there's nothing average about financial market outcomes or economic outcomes. There's cycles, and then ultimately those averages are really born out of the cycles. You mentioned something about fiscal policy that I think is worth unpacking in terms of how supportive it's been, how sort of regressive it's been, but ultimately it's really trying to figure out whether or not some of this fiscal largesse, if you will, can be sustained into 2024. I think the jury's still out on that, in my opinion. We certainly are going to have a smaller fiscal impulse. Now, whether that fiscal impulse is still positive remains to be seen. Thus far, it has been positive in the early months of fiscal 2024. So, this is our fiscal policy monitor, where we show the nominal year-to-date sum of different categories of federal revenue and federal expenditures. We just take the share of total by category, the year-over-year rate of change of that nominal year-to-date sum, and then we take the trailing 10-year Z-score of that change. There's a few things I wanted to highlight, because I think it's worth unpacking to help investors get a general sense of where fiscal policy is headed over the medium term. So we'll start with the revenue side. We get individual income taxes, which are about 49% of the federal budget, so usually around 50-ish% of the federal revenue. Those are down about 15% on a year-over-year basis. There's a couple kind of idiosyncratic one-off dynamics that are contributing to that, and obviously making the budget deficit wider. One, you have Hawaii and California were offline for most of the year in terms of contributing to their federal taxes because of natural disasters. And then you had this a change in tax brackets that allowed households and taxpayers to kind of keep more of their income prior to paying taxes next year. So that's contributed to extra cash in household pockets there. Then you look at the 8.7% cost of living increase adjustment that we observed in 2023. That obviously is unlikely to be repeated. We're somewhere around 3.2 in terms of the projections for 2024. That 8.7% manifested itself if you look at things like Medicare, which is 14% of federal expenditures, or Social Security, which is 22% of federal expenditures. Those are up 19 and 12% respectively. We're not going to see them up 19 and 12% respectively in 2024 because, again, we're not going to have such a big delta in terms of the cost of living increase adjustment. And then lastly, what you highlighted earlier, the sort of regressive policy of dumping T-bill T-bill yields into the bank accounts of rich people. So if you look at a net interest, it's now 12% of the budget, up from 5% in 2020, and that number is growing 43% year over year. Like, so 12% of the federal budget is growing 43% year over year. That is money that is going from Uncle Sam to the pockets of rich people like myself who are long USFR in our KISS portfolio construction process. So, that stuff's not going to be repeated in terms of those deltas, but they are, to some degree being sustained. So if you look at the year-over-year nominal change in the deficit, we peaked at $834 billion in June. So that was obviously a massive fiscal impulse and part of the reason we saw Q3 GDP at 5%. That number's dwindled all the way down to plus 320 billion in November. But importantly, the fiscal year starts in October. And so the fact that we're not, continuing to march downward in terms of these deltas is actually quite supportive of the fact that we could continue to see fiscal largesse support the economy in fiscal 2024. And that would make sense, right? Next year's an election year, so they're probably not going to turn it off very aggressively.
Yeah, I mean, that is exactly right. Like, so you could make the argument that the impulse, which as you say, like the delta, the change is less supportive. And I think that's absolutely right. Mm-hmm. But the aggregate deficit, it's hard to get. It's hard for me. We've done some modeling. If you just take interest, let's say they just took interest rates to zero tomorrow and like the interest expense went away, we'd still be running a deficit that's as large as any deficit outside of COVID that we've been running entering a recession. And so to me, there's still a lot of cushion for some of these tailwinds to go away. And then if you add to that now falling rates and stimulating the credit channel, and that's kind of why you can have, I think, that runway to make a confident soft landing prediction. And like you said, the big operating factor in the background is the election. And these are political animals and political institutions. And if you had any doubt about that, I mean, Yellen her role in implementing monetary policy during QT is huge. Mm-hmm. And we've seen that through these QRA episodes. And I feel like you get through those and people doubt how important they are, but I think they are important. I think the way, that's a whole other conversation, but I do believe the mix of bills and coupons and how they're issued is a massively important factor. And if you have a $2.5 trillion roughly a hole, when you add all of it together with QT and everything else, then that ends up that's a massive amount of bills that get dumped on the market if she's going to go keep doing what she's done. And it's stimulative is the bottom line. And so she's an important figure in implementing monetary policy. Now you have the Fed, who's a little less political, but still not immune from these impacts, who's also trying to do, has the election working in the background. Look, there's a reason why in an incumbent presidential election year, the stock market's never been down.
That's good to know. I didn't know that.
And people in power want to stay in power. And a big part of that is keeping the economic train on the tracks. And I think that they will next year. And so that is, to me, when you boil it all down, that's the big environment that we're all moving into. And you'd be naive to think that that's not impacting how the Fed's communication has changed in the last 2 weeks. And, there's a big debate over, there's a lot of angst in the economy right now. That's why I get it. I think I get it. I actually really do understand it. And I think those polls, like whether it's consumer sentiment, University of Michigan, things like that, and everyone debates and it really annoys me when you get these academics who kind of come out and tell average people that they don't really know what they think about the economy, that in reality, the economy is great. And you guys are just a bunch of bumpkins who don't understand what you feel. Like, no, people have agency. They understand what they feel. There are reasons for those sentiments. And And if I had to guess at one, I mean, there's reasons on top of reasons, but people don't like high interest rates, and I think they know that, so they're cutting rates in the election year.
100%, man. You hit on our friend Janet Yellen over at the Treasury Department. I think she's doing some of the best policy that I've seen in my 15-year career on global Wall Street in terms of flooding the market with T-bills and trying to kind of limit the impact of this sort of $2.5 trillion. You're saying it's right about we do the math on that as well. It's right around 2.6, $2.7 trillion in terms of net new issuance that they have to issue. And so she's been flooding the market with T-bills. If you look in terms of the most recent QRA, and in my opinion, we've been arguing this for several quarters now, which is this is fantastic policy. She should continue doing this until the black line here, which is the reverse repo facility balance, goes all the way to zero. Like it trended at zero, or really just north of zero for most of its existence. So there's no reason for it to have $800 billion in it. And so the Fed, I think she's doing a great job of tapping into that excess demand for T-bills relative to coupons. If you actually look at it on a ratio basis in terms of net marketable borrowing through Q1 of 2024, which is as far as the projections go currently, we're talking about 73% on a trailing 12-month basis of net marketable borrowing will be T-bills, and 27% will be coupons. And that's the lowest number we've seen since at least Q1 of 2018. So she knows exactly what she's doing. She's doing exactly what I would be doing if I were in her shoes, which is continue to kind of try to limit the market impact of this massive fiscal deficit and ultimately the Fed's quantitative tightening program. She's basically taking the teeth out of quantitative tightening. In my opinion, that makes a lot of sense in the context of a couple of charts. I'll just show you this. I'm not telling you anything you don't know in terms of core PCE disinflation. This is like as textbook as a disinflation as you're ever going to see. You got the 3-month SAR below the 6-month annualized and below the year-over-year rate of change. And we're kind of coalescing around 2.5% on both the 3-month and 6 months. So that's obviously telling you that there's a lot of positive outcomes happening from an inflation standpoint in the economy. You're seeing very similar dynamics with supercore PCE as well. So we get those numbers next Friday. So we'll see if they continue to confirm that. But in my opinion, I think she's enacting great policy. I think Jay Powell is in responding to these dynamics, not just in the inflation, but we're also seeing some fairly immaculate softening in labor market conditions in terms of seeing a reduction in labor demand, but primarily only coming from total job openings and not total employment, which is an unusual divergence. But as long as it persists, and based on the policy impulse that we just highlighted in terms of the easing of financial conditions and obviously the ongoing fiscal deficit situation, it's very unlikely that needs to change in the context of this big boost in productivity that we saw in Q3 and should be sustained. Any thoughts on any of that?
Yeah, I mean, I think you hit a lot of great points. I think number one, I agree with you that they know by basically the way that inflation measures are calculated that the disinflation is kind of in the bag at this point in time for at least the next 9 months. Now, I'm sympathetic to it, and you could make an argument that there is some recklessness to going for the soft landing. That on the back end we end up with a surge in inflation, and that's another concern for another day. I'm sympathetic to it. And when that cycle happens, we'll take that cycle as it comes to us. But right here and right now, inflation will trend lower. Our view is that in March, core CPI will be low 3s, and by June, it's going to be mid 2s. And the Fed's going to be cutting. We think the Fed's first cuts in May. I think everyone's getting a little bit ahead of themselves. But once they start cutting, it's not going to they're going to be hard pressed to keep hold things and just hold there. They're going to keep cutting. So I'm with you that there's that disinflationary backdrop that we talked about at the beginning for the soft landing ingredients. It's so powerful that it gives them this cover to take a risk and go for the soft landing. So that's number one. And yeah, I think that trying to remember some of the other points you made. I had something else I wanted to respond to. But it's
labor market slack.
The labor market, yeah, the labor market. So one of the things we've said is that the Fed's a big Phillips curve. It's academicians. They believe the Phillips curve and tight employment causes inflation. So they need to see some signs of loosening. And they also have people like Claudia Sahm out there, kind of with her Sahm rule, which is just a 3-month moving average of unemployment going up by 5.5%. That always, according to them, there is a false signal in 76, but according to them, that leads to a recession every time. And we saw that not in the 3-month moving average, but in the absolute peak to trough to peak, unemployment went from 3.4 to 3.9. And so I think that got alarm bells ringing at the Fed. But when you look at it, it's actually pretty benign loosening of the labor market. We've seen jolts fall. We've seen job openings fall, which I think jolts was always overstated, but let's set that aside. The Fed believes it. So job openings are down. The labor force has increased and payrolls have increased. And actually you've never seen the Somme rule triggered with this kind of payroll creation. And so it's kind of an anomalous increase in unemployment rate. And I would call it benign, honestly. The reason, if anyone's interested, why did the unemployment rate go up when you're creating basically the same amount of jobs as people added to the labor force, which if you were just tracking that at home, you would think, well, the unemployment rate should be steady. It's because about 700,000 of those jobs are from multiple job holders, and the unemployment rate's tracking the number of unemployed people. And so the new jobs, about half of the new jobs being created are second jobs for people in the economy. So that translates to a higher unemployment rate. Still, when you bake all this together and you compare it to previous recessions, it doesn't look a thing like any previous recession.
100%. Yeah, I've been saying that. There's a lot of immaculateness in this business cycle. And I think, one of the things we've been preaching our client base over the past few months is just having humility with respect to these business cycle processes. This is not a normal business cycle. There is not a textbook. There's not a example in the history of the textbooks that can tell you, okay, this cycle's playing out just like that. It's very unusual. We're observing from an inflation and labor market standpoint, but guess what? It is happening, and the markets are telling you it's going to continue happening. So if you're positioned otherwise as an investor, you have to have a lot of hubris in your ability to forecast some of these, very, hard to forecast dynamics in the economy, like the big bounce in productivity that we saw, which is taking pressure off of corporate margins and allowing corporates to, delay, if not, back away from, kind of cost reductions altogether. There's allowing corporations to back away from having to push through PPI increases to their customers. And by the way, PPI is back to a trend level. So there's really no more, impetus to kind of push through price increases to customers. So, we are very much on a credible path to a soft landing. This is something we've argued for the past, month or so, and in terms of this Goldilocks regime that our models picked up on and are definitely helping us make money here at 42 Macro. Before we wrap up, we had a couple questions in the queue, Warren, and I appreciate your time. We'll start with the first one. Craig, what's up, bud? Says, do you think it is a mistake for the Fed to place more focus on real rates to suggest restrictive policy rather than the totality of financial conditions?
I think that my inclination is to say that what's happened over the last month is there is some kind of mid-cycle adjustment that might need to be made. I think at some point in time. I think this was premature, if I had to guess. If I had to say that. Now, this is the way you avoid a recession. So from a short-term perspective, no, it's not a mistake. It's actually positive. I'm just not entirely clear on the risks on the back end, because you can see how much animal spirits have been lifted just by this little move, or not. It's not really a little. It's pretty important, but just the size of the rally. We've dropped in just 2 months. 120 basis points on the 10-year. Small caps have gone from a bear market to a bull market in just weeks. I mean, there's so much liquidity in the system. It's like trying to hold a beach ball underwater. And so I wonder about that. And I do believe my overarching thesis is that when this cycle is all said and done, we write the history on it, the Phillips curve is going to have lost credibility, and the wealth effect is going to be considered more seriously, which at this point in time, the Fed doesn't even consider the wealth effect.
Yeah, no, it's bizarre that they don't, because they spend so much time talking about financial stability risk, but they don't spend any time talking about how stable the financial system has become through the lens of the improvement that we've seen in the private sector balance sheet. Both households and corporates started this business cycle with levels of cash that we haven't seen since the 50s and 60s, respectively, with debt service ratios that we've not seen ever in the time series, with low levels of debt growth. This is a very, in terms of the monetary tightening that we observed, you can make the argument that going from 25 basis points to 550 basis points is a significant tightening, and it's probably restrictive, but not necessarily in the context of a lot of the credit market dynamics that we've observed and reported on really for 18, 19, almost 20 months now here at 42 Macro when we authored that resilient U.S. economy theme last summer. And then last question here from our buddy Marvin. What's up, Marv? It says, after the recent move in odds for a rate cut, I think March is 76%. Do you think it makes sense to take the other side of that trade? What are your thoughts about the outlook for energy stocks with that backdrop?
So those are kind of totally independent things in my view. Number one, I'd say the way we would take the other side of that trade, I think that bonds are, I don't think there's much more downside for yields at this point in time on the long end. Like say, let's call it the 10-year as a benchmark. I think the 10-year is already fully discounted a cut cycle, and term premiums are negative again. I don't think that's sustainable in this backdrop. And so, have we seen the absolute lows in yields? I have no idea about that. Maybe this rally, and it's kind of just a little bit of a short covering, and just absolute stampede for duration could continue for a little bit. But I don't find value in bonds, so we're underweight long bond. And after being, we went over, not to kind of beat our own chest, but we went overweight bonds after being significantly underweight at the absolute top in yield. We're like, hey, 5% on the 10-year, you got to push your chips on the table. This is the way we want to play a Q4 rally. And we took that off last week, I believe it was. And that was, so I think that we've kind of squeezed all the juice out of the bond trade. And that's how I would express that the cuts that are priced in are maybe a little over aggressive. Stocks, on the other hand, I think as long as yields just kind of normalize here, you don't want to express that by getting away this freight train in the stock market at this point in time. And so that's I'd say maybe that's a nuanced way to answer that question or to play it in my view. As far as energy stocks go, energy stocks are going to follow oil. We're on our oil model actually just flipped to a buy signal. I know that's going to be news to people. And our model has killed it this year. It's up in the last few years. I forget its track record off the top of my head, but it's up 120, 30% following its returns. And this year it's up 15%. Oil's down 10%. And so it's done a really good job. It's following a lot of the fading hedge funds and CTAs. So I think in the short term, this is probably a nice spot to put a trade on for energy stocks. But I really worry fundamentally about the OPEC spare capacity overhang. So last year we came in here, I said, I think that one of our contrarian predictions was that oil would touch $100 a barrel this year. We missed by like $1 or $2 on dated Brent. That's our benchmark. Next year, I think that we will see $55 oil at some point in time. So I think that it's range-bound trading still, but more of a downside bias next year because we got to see how that OPEC supply comes back. So don't want to get too bold up on energy or just leave it alone in your portfolio at this point.
100%, man. Well, this has been a tour de force, my friend. Very grateful to have you on the program. We'll definitely have you back, man. One of my final questions is I always leave our audience with this, which is, we've all been in the biz for a while now. What's the number one risk management lesson that you swear by today that you wish you knew at the beginning of your career?
Well, I have a little phrase that I keep in the back of my mind, which is we build conviction on fundamentals and we manage risk on technicals. Mm-hmm. If the price is moving against you in the hubris you're talking about, if the price is moving against you on something consistently, and you just, spitting into the wind is a really bad idea. The collective wisdom of markets is telling you something. And so risk management through price is the thing I've learned and saved my butt many times.
Same here, brother. Well, I appreciate you, Warren. This has been excellent, man. We'll definitely do this again sometime in the future, my friend. Appreciate y'all.
And
thank you, man. And we'll be back next month with our friend Jim Carson, friend of the show. Has been on quite a few times. He's had quite a great year as well. So we're kind of wrapping up with some folks who've done a great job of helping folks make and save money on financial markets in this program. So we'll see you guys next year. Next year. Happy New Year, happy holidays, and all that good stuff.